Most investors know about government bonds, but very few know there's a bond that pays more than G-Secs and is backed by Indian states. Today we will explain state development loans, how you can invest in them via mutual funds, how safe they really are, and what kind of returns you can expect. And no, you don't need crores or special access. On this channel we simplify money, debt, and investing without jargon. Today's topic is state development loans, or SDLs, a powerful but ignored fixed income instrument. State development loans are bonds issued by Indian state governments to fund infrastructure, welfare, and development projects. Issued by state governments. Auctioned by RBI. Similar to Government of India bonds. Used for roads, irrigation, power, education, etc. Right finger simple analogy. Think of SDLs as state-level government bonds, while G-Secs are central government bonds. This is the most important section. First question everyone asks, are SDLs safe? States cannot default easily. RBI tightly monitors state borrowing. Historically almost zero defaults. States get central government support if stressed. While there is no explicit sovereign guarantee, in practice SDLs have been extremely safe historically. Credit rating angle. Most SDLs are rated AA+ to AAA equivalent. Much safer than corporate bonds. Disclaimer. They are slightly riskier than central government bonds, and that's exactly why they offer higher yields. Now let's talk returns. This is where SDLs get interesting. SDLs usually offer 0.30% to 0.70% extra yield over same tenure G-Secs. Example. 10Y G-Sec. Approximately 7.0% 10Y SDL. Approximately 7.4% to 7.7%. For long-term debt investors, this extra yield compounds meaningfully. Who benefits most? Long-term investors. High tax bracket investors using debt funds smartly. Conservative portfolios needing stability plus yield. As a retail investor, you usually don't buy SDLs directly. The easiest and smartest way is through mutual funds. Checkmark mutual fund routes. Checkmark option 1. Dedicated SDL mutual funds. Yes, there are mutual funds that invest predominantly in state development loans. These funds typically hold 80 to 100% of their portfolio in SDLs, with minimal or no corporate bond exposure. Think of these as state government-only debt funds. Why they matter? Very low credit risk. Slightly higher yield than pure G-Sec funds. Cleaner portfolios with no hidden credit calls. Checkmark option 2. Target maturity funds, TMFs. Target maturity funds are still available, and new series continue to be launched. SDL-based TMFs invest in state government bonds maturing around a fixed year, like 2027, 2028 or 2030. If you stay invested till maturity, returns broadly track the yield at the time of investment, with much lower reinvestment risk. These funds work best as buy and hold debt investments, not for trading. Checkmark option 3. Gilt funds with high SDL allocation. Many gilt funds don't invest only in central government bonds, they also allocate 30 to 70% in SDLs. This provides a balance of liquidity from G-Secs and extra yield from SDLs. Important investor note. While SDL funds are very safe from a credit perspective, they are not risk-free. Longer maturity means higher sensitivity to interest rate movements, so time horizon matters. So today, investors don't just have access to SDLs, they have multiple well-structured mutual fund options to invest in state government bonds efficiently. This builds trust. Key cap 1 interest rate risk. Long duration equals NAV volatility. Rates up right pointing arrow NAV down, temporarily. Key cap 2 liquidity risk. SDLs are less liquid than G-Secs, but not a major issue via mutual funds. Key cap 3 not for short-term money. SDL funds are not parking instruments. Golden line. If you can't stay invested for at least 3 to 5 years, don't chase SDL yields. SDLs are ideal for investors who want better yield than FDs, much lower risk than corporate bonds, long-term debt allocation, stability with reasonable returns, not ideal for short-term needs. Those who panic with NAV fluctuations. State development loans sit in a sweet spot, higher yield than G-Secs, much safer than corporate bonds, and accessible via mutual funds. If you want a video comparing SDL funds versus corporate bond funds, comment SDL. If this helped, like, share, and subscribe, because smart debt investing is underrated.